How can you maximize your returns when you invest in mutual funds? We know that NAVs can go up and down on daily basis based on the movements in prices of assets like shares and bonds a scheme has invested in. We can maximize our returns in a scheme if we are able to invest when the NAV is the lowest and redeem when it is the highest. This is what is called as timing the market. That is, make an investment at the lowest prices and exit at the peak. It is a very simple concept, except that no one knows if the market is at the bottom or it is at the peak at any point in time. Can you say if BSE Sensex has hit a peak if it is trading at 30,000? What is the certainty that it will not climb further? What if it has come down from 30,000 to 24,000? Is it the bottom? Is there any certainty that it will not go down further? No one has a definite answer to such questions. You may wonder then, how should we decide when to enter the market or exit it? This is where SIP and SWP come in. Idea behind SIP is that you put aside a certain amount of money, say every week or every month, and invest in a specific scheme of a mutual fund. Such process helps you to overcome ups and downs of the market while investing. When fund is doing well, the NAV will be higher and hence number of units bought will be lower for a given amount of money. Opposite will be the case when the fund is not doing well. The NAV will be lower and hence you end up buying higher number of units from your fixed SIP amount. This works in your favor and you end up investing at a good average price over the SIP period. There is no point in waiting for NAV to fall before you invest, as it is very difficult for most of us to know when would that be the case. The other approach of investing a large amount of money at one go as lump sum is a risky strategy. You may end up investing on a day the market is at the peak and followed by a crash. If the market takes some time to recover, then it is likely that you may lose hope and exit at a loss. Even if you have a large sum of money, one should invest them in the lowest risk schemes like liquid funds and set up a systematic transfer plan to move it to the funds of your choices on a periodic basis. This would reduce the risk of entering the fund at the peak NAV. Please keep in mind that the taxation on redeeming of units is still applicable when you switch. The real advantage is that you don't have to wait for the money to come to your account on redeeming the unit from the first fund and then reinvesting it in the second fund. Since the fund house is the same, they can do it internally and is done at the end of the day when such request is made. We looked at investment. What about redemption? Should we exit completely at one go? What if market went higher after the exit? This is where SWP will be of help. When you are nearing your financial goals and want to systematically liquidate your investment. This process also allows averaging of the exit NAV. This could work well even for retirees who are looking for regular cash flows. Systematic withdrawal plan may be a better option than the so-called monthly income plan that tries to pay a monthly dividend. Mark the word try. It is not compulsory for them to pay a monthly dividend. Even if they want to, they need to have a distributable surplus to make such payments. Besides this uncertainty, the dividends attract dividend distribution tax in the hand of the mutual fund, and that results in erosion of NAV to the extent of the tax payable at 28.84%. Thus, the investor loses out. SWP, on the other hand, would allow you to take advantage of favorable tax law as you are selling the units. You would be taxed only on the profit made. The tax rate could be 15% or 0% for equity-based funds if units were held for less than 1 year or more than 1 year, respectively. A debt fund with growth option, on the other hand, would be taxed at your income tax slab rate for short-term gain if held for less than 3 years and taxation of 20% on inflation adjusted value of units if held for more than 3 years.